The worst performing sector in the S&P 500 real estate. Welcome to WealthEchelon, your go-to destination for expert insights on finance, stocks, and ETFs. Our mission is to empower you with the knowledge and strategies needed to navigate the financial markets with confidence. Whether you're a beginner looking to build a strong investment portfolio or an experienced investor seeking market trends and analysis, we've got you covered. Join us as we break down complex financial concepts, explore market opportunities, and help you climb the ladder to financial success. Subscribe now and take control of your wealth journey. The worst performing sector in the S&P 500, real estate. Since the pandemic began in 2020, the real estate sector has struggled to keep up with other sectors in the S&P 500. When reviewing the 5-year sector performance, technology and communication services have emerged as the top performers, with their gains surpassing the broader market. In contrast, real estate has underperformed, achieving only a modest 22% increase over the past 5 years, well below the overall market's growth. The rise of technology and communication. The strength of technology and communication services sectors, driven by cloud computing, e-commerce, and digital transformation, has pulled market attention and investment away from traditional sectors like real estate. The increased reliance on remote work and online services has benefited tech stocks, while real estate struggled to adapt, especially with office space demand falling as companies embraced flexible work-from-home policies. In addition to rising interest rates, high inflation has placed downward pressure on real estate valuations. For REITs, inflation can affect operating costs, reduce profit margins, and make certain types of properties less attractive to investors. High inflation also means that properties in certain sectors, like retail, face even more headwinds as consumers become more price-sensitive. Key takeaways. One major takeaway is how much weight the technology and communication sectors have carried. They are the only two sectors that have outperformed the index as a whole in the past 5 years. This indicates that while the S&P 500 has performed well, the broader market has struggled. The second takeaway is real estate's significant decline, largely due to its sensitivity to interest rates. With high inflation leading to elevated interest rates, real estate investments have suffered. However, with the Federal Reserve signaling that interest rates will decrease over the next few years, there may be opportunities for long-term investors. While it may not be the right time to aggressively invest in REITs, it is a good period for accumulation. Investors may look back in 2 to 5 years and wish they had purchased more real estate investment trusts, REITs, at current levels. 3 dirt cheap REITs to consider. 1. Realty Income, a strong yet undervalued REIT. Realty Income is one of the most well-recognized real estate investment trusts, REITs, known for its net lease retail properties. The company currently has a market capitalization of $50 billion and has built a reputation as a stable, income-generating investment. It operates over 15,000 properties across different sectors and has long-term lease agreements with a diversified tenant base. Dividend strength and stability. One of the standout features of Realty Income is its monthly dividend payments, which have made it particularly appealing to income-focused investors. The company has paid and increased its dividend for more than 25 consecutive years, earning it the status of a dividend aristocrat, a rare achievement in the REIT sector. Currently, Realty Income offers a dividend yield of 5.6%, significantly higher than the average S&P 500 stock. While its 5-year dividend growth rate stands at 4% per year, which is not exceptionally high, it still provides steady and reliable income. Realty Income's A- credit rating further reassures investors of its financial stability and ability to sustain dividends even during economic downturns. Tenant and portfolio diversification. Realty Income's vast 15,000-plus property portfolio is spread across retail, industrial, and other commercial sectors, making it one of the most diversified REITs. The company follows a net lease model where tenants are responsible for property expenses like taxes, maintenance, and insurance, reducing Realty Income's operational risks. Its top tenants include Dollar General, Walgreens, and Dollar Tree, each contributing about 3% of total rent. While discount retailers have been relatively stable, long-term risks exist, especially as e-commerce continues to impact brick-and-mortar stores. However, since no single tenant contributes an overwhelming percentage of rent, the company remains well-diversified, reducing the risk of revenue disruption. Additionally, Realty Income has expanded into non-retail sectors, including data centers, casinos, and hospitality properties, further diversifying its revenue streams and reducing reliance on traditional retail. Valuation and growth potential. Realty Income is currently trading at a forward price to FFO, funds from operations ratio of 13.1, significantly lower than its 5-year average of 17.2. This suggests the stock is undervalued, given its consistent cash flow and high-quality assets. Even if the stock does not return to its peak valuation, a conservative multiple of 16 times FFO would push the share price to $69, representing a 21% potential upside, excluding dividends. When factoring in its 5.6% yield, the total return potential becomes even more attractive for long-term investors. Second Stage Industrial, a strong play on e-commerce growth. Stag Industrial is a real estate investment trust, REIT, specializing in industrial properties, primarily warehouses and distribution centers. With a market capitalization of $7 billion, it is significantly smaller than Realty Income, but operates in a sector poised for growth, industrial real estate. Unlike many REITs, Stag Industrial has held up relatively well despite market challenges. Over the past year, its shares have declined by 8%, but in the past 5 years, the stock has risen by 8%, reflecting steady long-term performance. E-commerce and industrial real estate growth. One of the key reasons for optimism around Stag Industrial is the continued rise of e-commerce. In the U.S., e-commerce sales still make up less than 20% of total retail sales, while in markets like Europe and the UK, they account for nearly 30%. As online shopping expands, the demand for industrial properties, warehouses, and logistics centers will continue to grow. Additionally, onshoring trends and changes in global trade policies, such as tariffs on Chinese goods, are encouraging companies to move manufacturing and supply chains closer to home. This shift is increasing demand for warehouse and storage space in the U.S., benefiting companies like Stag Industrial. Dividend stability and growth. Stag Industrial is an income-focused REIT, paying a monthly dividend, an attractive feature for long-term investors seeking consistent cash flow. It currently offers a dividend yield of 4.2%, lower than Realty Income's 5.6%, but still solid for a REIT. The company has also increased its dividend for 12 consecutive years, showcasing its ability to generate stable cash flow and support dividend growth. Tenant and portfolio strength. Stag Industrial's 580 industrial properties are well diversified, with Amazon as its largest tenant. Given Amazon's dominance in e-commerce, this is a strong indicator of the company's strategic positioning in logistics and fulfillment centers. Beyond Amazon, Stag Industrial's properties serve a variety of third-party logistics providers, retailers, and manufacturers, reducing concentration risk and providing a stable, diversified income stream. Valuation and growth potential. Currently, analysts estimate Stag Industrial will generate $2.10 in funds from operations per share in 2025, leading to a forward price to FFO ratio of 16.6. This is below its 5-year average of 19, indicating the stock is trading at a discount. If Stag Industrial's valuation returns to a multiple of 18.6, the stock price could reach $40 per share, representing a 15% upside. When combined with its 4.2% dividend yield, the total return potential becomes even more attractive. Third, gaming and leisure properties. Gaming and leisure properties is a hospitality REIT specializing in casinos and hotels, with a market cap of $13 billion. Over the past year, its shares have risen by 8%, but over the past 5 years, they have declined by 2%. This REIT is heavily dependent on the strength of the consumer economy. If the labor market remains strong and consumer spending continues, it could be a lucrative investment. However, if unemployment rises, this REIT could face challenges. The company currently offers a dividend yield of 6.2%, the highest among the 3 REITs discussed. It has increased its dividend for 4 consecutive years, although it had to cut its dividend in 2020 due to the pandemic. Gaming and Leisure Properties owns nearly 70 gaming properties across 20 states in the U.S. Its top tenants include Penn Entertainment, Boyd Gaming, and Caesars. From a valuation perspective, analysts expect it to generate $3.91 per share in FFO in 2025, leading to a forward price to FFO ratio of just 12.5. This is well below its 5-year average of 14. If it returns to its historical multiple, the stock could reach $55 per share, offering about 15% upside in addition to its high dividend yield. Each of these three REITs offers a different investment opportunity. Realty Income is a reliable, high-quality retail REIT known for its stability and monthly dividends. STAG Industrial benefits from the rise of e-commerce and industrial demand. Gaming and Leisure Properties provides exposure to the hospitality and gaming sector with a high dividend yield. As interest rates are expected to decline over the next few years, these REITs could see strong recoveries. Investors should carefully consider their risk tolerance and long-term goals before making any investment decisions. That's it for today's video. If you found this helpful, don't forget to like, subscribe, and turn on notifications so you never miss an update. At WealthEchelon, we're all about helping you navigate the world of crypto, investing, and financial growth. Have any thoughts or questions? Drop them in the comments below. I'd love to hear from you. Stay sharp, stay invested, and I'll see you in the next one.